But if you think about it, there are three major categories of investment. And you ought to think very hard about which category you want to be in before you start thinking about the choices available within that category. Now, the first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And if you will reach in your pocket, I don't like to do this, but and pull out your wallet. You're watching an historic event. If you look at this, and I might point out this is a 1, Charlie carries on the back of it, it says, "In God we trust." And that's really false advertising. If Elizabeth Warren were here, she would say, quite properly, it should say, "In government we trust." Because God isn't going to do anything about that dollar bill, if government does the wrong things in terms of keeping it as valuable as it was when you parted with it to buy a bond or put it in a bank. Any currency-related investment is a bet on how government now and in the future will behave. And if you happen to be fortunate to live in Zimbabwe and you decided to make currency-related investments, your family would have left you by now, and it was not a good decision. Almost all currencies have declined in value over time. I mean, it maybe built into almost any economic system that it will be easier to work with a currency that declines in value than a currency that appreciates in value. And the Japanese might reaffirm that here with their experience. So as a class, currency-related investments, whether they're in the UK or the United States or any place else, unless we're getting paid extremely well for having them, we do not think make much sense. The second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And the classic case of that is gold. And I've used this illustration before, but if you take all of the gold in the world, don't get too excited now, and put it into a cube, it will be a cube that's about 67 feet on a side. It'd be 165,000 or 170,000 metric tons. So you could have a cube, if you owned all the gold in the world, you could have a cube that would be 67 or 68 feet on a side. And you could get a ladder and you could climb up on top of it and you could say, I'm sitting on top of the world, and think you're king of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it, but it isn't going to do anything. It's all you are doing when you buy that is that you're hoping that somebody else a year from now or 5 years from now will pay you more to own something that, again, can't do anything. The person then thinks that somebody else will buy something 5 years later from him. In other words, you're betting on not just how scared people are now of paper money, you're betting on how much they think a year from now people will be scared 2 years from then on. Keynes described all of this, I think it was in chapter 12 of the General Theory, when he talked about this famous beauty contest where the game was not to pick out the most beautiful woman among the group, but the one that other people would think was the most beautiful woman. And then he carried it on to second and third degrees of reasoning. Anytime you buy an asset that can't do anything, produce anything. You're simply betting on whether somebody else will pay more for, again, an asset that can't do anything. And actually, we did that with silver, but silver had an industrial use. And about 13 years ago, I bought a whole lot of silver. And if you'll notice, silver's moved recently. So my timing was only about 13 years off, but who's perfect? The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time. And those are the assets that appeal to me and Charlie. Now, there's some logical follow-on to that. If you buy that farm and you really think about how many bushels of corn, how many bushels of soybeans will it produce, how much do I have to pay the tenant farmer, how much do I have to pay in taxes and so on, you can make a rational calculation. And the success of that investment will be determined in your own mind by whether it meets your expectations as to what it delivers. Logically, you should not care whether you get a quote on that farm a day later or a week later or a month later or a year later. We feel the same way about businesses.
You've often stated that value and growth are opposite sides of the same coin. Would you care to elaborate on that? And do you prefer a growth company that is selling cheap or a value company with moderate or better growth prospects?
Well, actually, I think you may be misquoting me, but I've really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to growth usually is a positive for value, but only when it means that by adding capital now you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So there is no, we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. As I mentioned at Flight Safety, we're going to buy $200 million worth of simulators this year. Our depreciation will probably be in the area of $70 million or thereabouts. So we're putting $130 million above depreciation into that business. Now that can be good or bad. I mean, it's growth. There's no question about it. We'll have a lot more simulators at the end of the year. But whether that's good or bad depends on what we earn on that incremental $130 million over time. So if you tell me that you own a business that's going to grow to the sky, and isn't that wonderful, I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. Charlie?
Well, I think it's fair to say that Berkshire, with a very limited headquarters staff, and that staff pretty old, we are especially partial to laying out large sums of money under circumstances where we won't have to be smart again. In other words, if we buy good businesses run by good people at reasonable prices, there's a good chance that you people will prosper us for many decades without more intelligence at headquarters. And you can say, in a sense, that's growth stock investing.
Yeah, if you'd asked Wall Street to classify Berkshire since 1965, year by year, is this a growth business or a value business, a growth stock or value stock, who knows what they would have said. But, the real point is that we're trying to put out capital now to get more capital, or money, we're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.